Good afternoon, ladies and gentlemen. My name is Ngatia Kirungie, and I'm the head of the Secretariat of the Kenya Pension Fund Investment Consortium. I'm here to talk about Kepwick, for short, and some of the lessons learned as a Kenya Investment Mechanism business partner. But before I start, maybe I should start off first by thanking our hosts for having us today, the Kenya Investment Mechanism, and all the support they have provided Kepwick since our inception up to date. I'll start with a little bit about Kepwick. So Kepwick is a consortium of local pension schemes, both public and private sector, large and small, that have come together to jointly assess and invest in infrastructure opportunities in our region. So in Kenya first, but eventually going into the wider East African region. We have a 5-year target of investing at least $250 million into infrastructure, and which has previously really been the domain of governments and the donor community. And we strongly believe that there is a big role for Kenyan pension schemes and the private sector in general to play in the infrastructure development of our country. Our aim is to provide competitive returns and diversification opportunities to our members while building on their technical and investment capacity. And finally, to be the collective voice of our members on policy and regulatory matters. A quick summary of our goals include, as I've mentioned, to assess and select suitable infrastructure investment opportunities that generate higher returns and reducing the risk for our members through diversification, to establish a pool of funding for these infrastructure assets, because we can do a lot more together than we can individually, to enhance the collaboration of retirement funds or retirement schemes, to attract co-investments from offshore investors such as US pension schemes, South African pension schemes, and those in West Africa, to build the capacity of our members, and to advocate for our members' interests. We have a number of partners, first of which is the USAID's Kenya Investment Mechanism, who have generously supported the Kepwick Secretariat. We're also supported by the World Bank Group and MIDA advisors. And Kepwick has actually been recognized as the Pension Fund Infrastructure Initiative of the Year. This was back in 2019 at the Africa Investor Awards in Cape Town in South Africa. So much so that the pension schemes in Southern Africa and West Africa are looking to replicate what we are doing here in Kenya by bringing themselves together to jointly invest in opportunities in their markets. So Kepwick was officially launched on the 21st of October last year, and this was at the Movenpick Hotel, and at the event, we had a number of high-profile speakers just showing support from the U.S. government through the former U.S. ambassador to Kenya, Mr. Kyle Makata. We also had Dr. Julius Muya, the principal secretary at the National Treasury, as well as the CEO of the regulator, Retirement Benefits Authority, Mr. Nzomo Mtuku, as well as others. And I would encourage, if you haven't, to check out our website, which is kepwick.co.ke, where you would be able to see a lot more of the events and happenings of the day. But if we take a step back and ask ourselves, why is infrastructure a compelling asset class for pension schemes to invest into? A number of reasons are very apparent. First, infrastructure provides competitive returns. Now, we would not even be having this discussion if that wasn't the case. So infrastructure, the returns are quite attractive, and they provide reliable cash flows. Secondly, as I have mentioned, infrastructure provides a good opportunity for diversification for our members' portfolios. And this is especially important in a market like ours, where you find that majority of pension scheme portfolios are invested into government securities and probably just a handful of stocks. There is definitely a need to increase the pool of investable opportunities for these pension schemes, and infrastructure is a great alternative asset to do so. Finally, infrastructure investments are long-term in their nature, and so they allow pension schemes with long-term liabilities to match those liabilities to a long-term asset. At the same time, when you're thinking about a long-term investment, it's important to consider inflation. Infrastructure, because of through its very nature and because it's typically tied to inflation, at least the revenues are tied to inflation, what that means is that in 10 years' time, if inflation goes up, rather than it eating into your returns will go up with inflation, and so you are always protected. And that's very important for long-term investors like pension schemes. So if that's the case, the question really is, so why aren't local pension schemes investing in infrastructure already? And there are a number of reasons to that. The first is that there's limited awareness of these opportunities in the first place. And that's no one's fault. That's completely understandable. And that's because pension schemes have, up to now, they have not been seen as a typical source of financing for infrastructure opportunities. So you'd hardly ever have banks or project sponsors knocking on the doors of the typical pension scheme looking for financing. Well, but even if they did, even if we were aware of the opportunities, we must recognize that infrastructure it's a very new asset class for our members. And as such, there is limited investment expertise in-house, as well as with our service providers, such as the fund managers. Thirdly, the next hurdle is the large investment size. These opportunities often run into the billions in dollar terms, and often are too large for one pension scheme alone to execute. And lastly, regulatory uncertainty. The big question we all had is, how does the regulator think about infrastructure? Where would an investment, say, into a power project or into a road project, where would that fit in terms of the regulations? Because no one wants to fall foul of the law, of the regulations. So ladies and gentlemen, that is the reason why Kepwick was formed. Kepwick was formed to address those issues. Firstly, to bring the investment expertise to our membership, to grow their capacity, and to make the trustees and the fund managers just as familiar with how infrastructure investments work as they would be, or as they are with stocks, bonds, and property, for example. Kepwick is also looking to bring a robust deal pipeline of opportunities for these pension schemes to review and invest. As I mentioned, we are looking to pool together the funds of or the investments of various pension schemes, because we can do a lot more together than we can alone. We're looking to put in place investment guarantees where possible, and to increase the liquidity of these investments by teaming up with the likes of the Capital Markets Authority and the Nairobi Securities Exchange to have our investments listed. And finally, working very closely with the regulator to provide this regulatory certainty that is required. But all that is really to achieve two goals. The first is to provide our members with higher returns and to provide them with lower risk through diversification. So since our launch, we've been in the market looking for various opportunities for our pension schemes to look at. And what you see in front of you right now is a slide that summarizes what I would call our wish list. So what are the typical characteristics of a project or an investment that we were looking at? And the first thing is that the opportunity would primarily have to be in Kenya. And that's really because we are more familiar with our nation, and it provides us with an opportunity to actually go and see the investments or the assets that we are investing in. Secondly, we'll be looking at brownfield projects, or projects that have some form of track record in existence that can be analyzed. But in the absence of that, a guarantee of some sort or credit enhancement of some sort would also be appreciated. And as you will see when we go to the investment opportunities we're looking at, that has been secured. We're also looking at financing in local currency, because as pension schemes, our funding base is in Kenya shillings, and it is important that we also invest in Kenya shillings so as not to take any additional currency risk. We're also looking at using debt as the preferred investment instrument. That's because our members are very familiar with how debt works. It's also more conservative, it's less risky, which is in line with the conservative nature of our schemes. And on that debt, we're looking at returns above government bonds, so that our members, if they're cycling out of government bonds into infrastructure, do not lose any potential returns. Finally, we're looking at projects that needed the capital within about six months, and the investment horizon of about 5 years plus. So since the launch, we engaged with over 30 stakeholders, and these include the commercial banks, the investment banks and their advisors, project sponsors and investment funds. We reviewed over 17 transactions or 17 deals, and we shortlisted 5 of them. These 5 can be categorized or can be placed into 3 categories, as you can see, the shortlisted opportunities. The first being in student housing, and in this case, we're talking about the Aecon Green Bond and Aecon Student Accommodation REITs. The second category being roads, or you can put it a bit wider, transport. In this case, there is the Lot 3 road bond, as well as the Nairobi-Nakuru Mau Summit Highway. And the third category being energy or power. And in this case, it was a heavy fuel oil power plant on the outskirts of Nairobi that was looking to refinance their balance sheet. In all the 3 categories and in all the 5 opportunities, we either had investment guarantees in place, or where that wasn't available, like in the power projects, we had existing pension schemes that were invested, so we would not be the first movers there, and we can learn a lot from what our peers have done in the past. But also, those assets or that asset had a very good track record and had returns that we could analyze, going back over 5 years. So if we talk about the first project, which is the Lot 3 project bond, as you can see, the issuer is a consortium called the HAS Consortium GVR Infrastructure Limited. They were looking for 2 billion shillings, or about $20 million, through a bond. And the interesting element about this bond was that it's 100% guaranteed. And it's guaranteed by a multilateral called Garantco, which is supported by the governments of various European nations, including the UK, Switzerland, Netherlands, France, as well as the government of Canada. It's important to note that Garantco is very highly rated, and in fact has a stronger credit rating than even the government of Kenya. So what you would expect to see in that situation is that any bond that's guaranteed by Garantco should have a lower return than a regular treasury bond. However, as I mentioned, it's important that our members do not lose out on any potential returns. And so what we have been able to do is negotiate with the project sponsors to have a spread on top of government bonds, so that by the time our members are entering into this transaction, they're actually making more money than they would before, plus that transaction is guaranteed. So it's a win-win in all cases. So the Kenya Investment Mechanism have supported us through this transaction from the very beginning. And there are a number of activities that we have undertaken with their support. The first thing we did was the development of an independent project assessment summary. And that was important so that we can go to our members and show them independently, away from the sponsors or their transaction advisors, what are our views of that investment opportunity. We were also able to show them best practice of pension schemes the world over and how they should be thinking about investing into a road project. And that was very well received by our members. Secondly, we convened the inaugural Kepwick Infrastructure Investment Opportunities Conference. This was in June 2021, highlighting this particular opportunity. And we had almost 120 attendees from 24 pension schemes, or it was in fact even more than 24 pension schemes, and I believe it was 12 or 13 fund managers. After that, we had regular weekly follow-up meetings with all the schemes that were invited, plus more, their fund managers, and helped them deliberate through the opportunity and go through their internal processes to get to an investment decision. So just a summary of the event. As you can see there, we had 119 attendees from 24 pension schemes representing 12 fund managers. Of the attendees, about 50% were pension scheme trustees. About 30% were from the fund management community, as well as administrators and other service providers, with the balance being split between the project sponsors, and the industry regulators, Retirement Benefits Authority and the Capital Markets Authority. So we have quite a few lessons learned through this process. The first is the importance of having credible transaction advisors to gain the confidence of investors, in our case, trustees and the fund managers. This transaction would have been a lot more difficult if the sponsors approached us directly and didn't have a strong name behind them that we had confidence in and that had structured the transaction in a manner that would be appropriate for our membership. So I think that's a good point to raise in terms of the importance of the BAS providers and how they can really do a lot to unlock private sector capital that is just waiting for well-structured projects. Second lesson learned was the importance of giving yourself sufficient time. Very rarely do these transactions happen as fast as we would like them to. And what we learned is that it's important to give yourself enough time to allow the completion of the required documentation and sufficient time for internal deliberations. You'd be surprised at how many rounds of discussions you'd have to have with each pension scheme's investment committee, the board of trustees, their fund managers, and back again. So the third lesson learned is really about the guarantees. And the guarantees, while very welcome, we consider them as training wheels. And they're the training wheels that will allow pension schemes to begin investing into infrastructure, but after some time, these training wheels will fall off. And then we will have to invest on our own, basically on the merits of the project, and which is fine. However, any kind of guarantees in place, while welcome, should not come at the expense of returns. As I mentioned, the transaction that we are looking at had guarantees, but still had to have a sufficient return for our members to participate. I've talked about the fund managers quite a bit, but let me just reiterate that the fund managers are really important in unlocking money from pension schemes, and it was really important to have the buy-in from them on these investment opportunities, even before approaching the pension schemes, because the fund managers are the pension schemes' trusted advisors. And we recognize that, we respect that, and we are working very closely with them on all opportunities. I mentioned the number of engagements. So one-on-one presentations are extremely critical. And we find that investor awareness doesn't happen with just one engagement. Investor awareness or investor comfort really requires multiple engagements from multiple touch points, and a lot of patience is required to do that. And so having support of the Kenya Investment Mechanism to really facilitate those kinds of engagements has been critical. And finally, it's important to note that there are also non-investment risks that should be addressed. These are such as reputational risks or concerns about the role of government, corruption, political exposure, and the likes. So these are the risks that are not seen in the financial models or typically in the documentation for the transaction or the teasers. So what we learned is that it's very important that even if they do not show themselves in the numbers, that they are adequately addressed. So with that, I will stop the presentation here. And I just want to thank you very much for having us. Again, KIM has been a very important partner to Kepwick, and we look forward to continuing working together and to growing the relationship in the future. Thank you.